following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, and welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call this here Options Insider Radio Network. And if you like this program and you're into the hardcore machinations that go on behind the scenes in the world of options, all the things that really power your trades from when you click the mouse to where they end up in the clearinghouse and back again, then you're going to love the latest addition to the Options Insider Radio Network. You may have already seen it, Trading Tech Talk. It premiered earlier this week. It's a fantastic deep dive into the hardcore, super powerful, super cutting-edge technology that powers all the stuff we're talking about on this show and every other show on our network, all the cool stuff that powers all the derivatives trading that we love so much. So if you're interested in that, if that sounds appealing to you, check it out, Trading Tech Talk. You can find it in all the same places you find the Options Insider Radio Network content, iTunes, the Options Insider website, Stitcher, Aha Mobile, wherever you find that stuff, you can find that show. So check it out. I think you're going to like it. All right, and joining me on the program today, my usual cohort, my partner in crime, my volatility co-host, none other than Mr. Mark Sebastian from Swan Wealth Advisors and from OptionPit.com. Mr. Sebastian, welcome back to the program, sir.
Hello. I called you up to say hello. Can you hear me, Joe?
How are things in Swan/Option Pit land these days?
Things are real good. Swan, everything's beautiful at Swan. Everything's beautiful at Option Pit.
I was going to say, these
I'm a happy camper.
These are the kind of markets you guys must love, particularly over at Swan, because, like I said, anyone can make money when it's going up, but when things get a little choppy, when things start dropping a little bit, people start turning towards people who like to hedge and do overlay strategies, and that's kind of exactly what you guys do.
Yep. Yeah, this is the kind of stuff we live for. This is the kind of stuff that gets people knocking on the Swan Wealth Advisors door because they go, oh, wait a minute, there's a smarter way to go long equities than just diversification, and that's really what we offer.
And these are also the kinds of markets when there's a little bit of risk in the air, people are getting a little bit worried. We're seeing a little bit of perhaps of a correction in the broad markets. When people start looking for perhaps some help doing that, they may indeed even reach out to a consultant to help them handle that risk management, that risk mitigation. And so we have the good fortune to be joined today by our guest co-host, holding down the Russell hot seat on the show today. He is Mark Shepard from Derivatives Strategy Consultants. You may remember him, listeners, from his appearance. It was, I believe, it was almost a year ago. It was February of last year. You can check it out back on episode 79 in our archives on iTunes, Stitcher, our website, wherever you find this program, to check out more detail about what he does over there. Now, Mr. Shepard, welcome back to the program.
Hey, Mark, how you guys doing today? I appreciate your time and look forward to the discussion today.
Now, for all of our new listeners joining us since the last time you appeared on the program, why don't you go ahead and give us a quick overview of what exactly it is you guys do over there at Derivatives Strategy Consultants?
Absolutely. Well, like Mark, we love volatility, and especially we work with ultra high net worth individuals as well as institutional clients to provide customized solutions based solely on optionality, whether that's equities, indexes, ETFs, or even multi-asset class futures options. We bring those solutions to the table. Could be tactical trading, could be hedging. We bring the delivery of those services to the clients, and their needs come first.
And who do you guys typically work with? Who's a typical client who's coming for some derivatives strategy consulting?
That's a great question. Right now, some great clients have been financial advisors who want to go out and really capture the whales, the ultra high net worth individuals. And what we talk to financial advisors about is being able to use optionality, not only to hedge, not only to tactically trade for them, but for tax purposes, to use optionality as a way to bring those clients in and to offer those solutions. Secondly, there may be RIAs or asset managers that want to bring on more subject matter expertise to their existing platform. And that's what DSC really brings to the table.
All right, well, we're glad to have you on board. This is not going to be confusing at all with 3 marks, so we'll be sure to have some sort of lingo to denote who we're talking to. But now it's time to keep on rolling right on into our first segment, the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, and welcome to the Volatility Review. As the man said, this is the portion of the program where we break down the week's worth of action, the week that was, if you will, from a volatility perspective. And it was something of an interesting week. We're recording this on Friday, January 31st, for those of you who like to play the home game and know all the dates. So if you know that date, you know exactly what type of volatility environment we were looking at. And Mark Sebastian, it certainly is a little bit quieter today than the last time you and I sat down to do this show. And the market was pretty much just taking a dive the whole time.
Yeah, really weird day. I mean, it looked like it was going to be abysmal on the open. Pre-market, the S&Ps were the equivalent down of about 25 handles, 25 points, if you will. And the VIX was exploded. Now, one key thing here, Mark, is, people are going to look and they're going to see that the VIX, the S&P was mostly down a touch, and the VIX is up a touch. But remember, we were up 20 handles yesterday, and the VIX ended up only down 6 points. And the VIX futures have been rallying all day. They're now officially backward. There is all kinds of ugliness in this market. I don't see an all clear here as I look at things. And if anything, I see I'm not going to, I think that I'm not a technical analysis guy, but I do believe that there are kind of levels that people watch. And that 100-day moving average of 1769, every time we get there, we bounce. And I'm wondering how many times buyers are going to be able to come in and make that thing bounce before it finally breaks. And I think that's going to be kind of the key thing to watch. That 1770 level is where we've really been able to hold support. So crazy day. VIX futures sound like VIX is going to be here for a while. One other little piece of interesting thing, Mark, is they are really holding up VIX, but the volatility of options on VIX have been for sale for the last 2 days. It's a synthetic time spread. So what they're basically doing is buying the gamma and selling the vega. It's a time spread, but they're doing it in kind of they're trying to do it like a theta neutral way, if you will. So they're trying to get the gamma and then the gamma out of the S&P options, and then they're trying to sell vega via VIX and collect some premium. And I think that's what we're seeing out of the market over the last 2 days, is people want that realized volatility exposure, but maybe they don't think that there's as much of a hedge on the Vegas side anymore.
A good point, too. When you're trading the VIX options, not exactly a beast for gamma. You really need to go straight to the more direct type underlying options to really get that true gamma. I mean, there is gamma in VIX options, but it's kind of more of a mixed bag, to put it charitably.
Yeah, there's great gamma in VIX options in these early moves or when it's making big moves. But if the VIX is trading 18 and you think we're going to go to 21, then a VIX option is probably not the right way to hedge a portfolio. If the VIX is trading 18, you think we're going to 35, there's a hedge. So what the market's basically telling us is, hey, you know what? We do think vol is going to go higher, but we don't think the VIX is going to go to 30 or 40, where the trading looks more like 20, 21 is where everybody's betting.
That certainly seemed to be the narrative this week. We've talked. Well, first off, we joked on this show going into the new year and on some of our other shows on this network that we didn't see much that was really going to juice vol, and we were thinking that it might get down even into the single digits in Q1. I believe it briefly touched in some level in the 9 handle or so very quickly in the VIX cash before turning around immediately and bouncing back. So I guess technically we were correct, but so far we've actually seen some vol being put in by the aggregation of all these forces, earnings, all this emerging market stuff, and just about everything else you can imagine piling in to the markets right now. We talked on the show last week. People were loving VIX upside. It seems to have worked out all right, at least in the near term. The call put ratio was at record levels. It still is hovering right around the 3-to-1, which is a pretty aggressive, right near record highs level. When people always love VIX calls anyway, it's always call heavy, kind of by definition. That's why people come into this product. They're buying calls mostly, but 3-to-1 is pretty high even for the VIX historically. And yet, you're right, Mark. People are starting to see some lines in the sand, some levels of where VIX upside may start to cap itself, at least in the near term, because probably the biggest trade we saw in VIX, at least from VIX options this week, was a huge size call seller on Monday. We saw someone coming in selling about $18 million worth, which I think worked out to about $250,000 Feb 22s for levels around 70 cents. Let me just see if those are still. Yeah, so there's 427,000 open on that strike right now. So just a size call seller here at the Feb 22 level. That's something interesting because we've talked so much about how there is so much upside and seems like the crazies come out in Feb all the time. And yet we're starting to see people actually doing what we said for a while they should be doing, which is maybe selling some of that. This guy saw a nice pop in the VIX cash, took advantage of it, sold a decent level in Feb for a ridiculous amount of size, and seems to have worked out at least all right for him so far. What do you think about that trade, Mr. Sebastian? $250,000 Feb 22s.
That was a big one. And then the other one is, there was a guy that had bought 120,000 of the 1620 call spread in Feb. He paid 14 cents for it. Closed it out today for $1.20 near the lows. So
that
he's
also
feeling
works.
pretty nice about himself.
That also works pretty well.
Maybe his portfolio lost a little bit of money in the equity side, but he made a clean. What is that? That's let's do some math here. That's 120,000. 1, 2, 3 times 1.06 times 100. So he made a clean $12.7 million. So he's got that going for him at least.
And I'm certain that goes to offset at least some of what he lost, because you're right, those kind of trades very rarely go up in a vacuum. Usually it's against something else, probably a broad equity portfolio. So he probably took a little bit of a hit there, but overall he did all right. He took advantage of that, one of those few moments when you do get a little bit of gamma, some movement in VIX, and it actually worked to his favor. Now, Mark Shepard, this is obviously, like we said, a good environment for you on the consulting side as well. A lot of people are starting to wring their hands and start to be worried about their long equity portfolio. They start to these are the kinds of times people take a second look at their option products and say, hey, maybe I should know a thing or two about these. So what are you seeing in the recent activity that's really catching your eye from a vol perspective and both from an underlying perspective? And then also, what are you hearing from your clients? What questions are they starting to come to you with? What calls are you receiving in this marketplace, given all the crazy stuff we're seeing unfolding right now?
Sure. First point, listen, we all know it was Mark Sebastian that made the call and made the 250,000 contract trade there.
That's actually small. It's actually small size for him. I expect bigger size from him.
Specifically with some of the call to put ratios in the VIX now, I think Mark touched on it very well. I would continue to see that a majority of these positions, the call to put ratio, will probably be held. They're not necessarily going to be traded. They should be spread out to a different time frame. However, I think these are majority PMs or risk managers that are trying to trade via 2 to 3 months out, and that if the explodes to a certain point, then they might get out. But I think that the calls will continue to be held, especially when you're seeing this emerging markets scenario, this possible meltdown. And I think that, especially with what's happened in the market today, that when you have emerging markets selling off, when you have concerns in China, really where's the world going? They're looking for liquidity. They're going into our bonds and they're going into our stock market. Yes, the S&P went down to 1269 or 1769 overnight, but I think people are looking for the safety and security. The American markets, the liquidity of our markets are still there. So I think you're seeing people from around the world invest in our markets. And I think, to my first point, is that there is still concern. So they're going to continue to hold these hedges, actually in the VIX.
Now, Mark, of course, you mentioned the emerging market stuff, and that's something we don't talk about a lot here on this show. But you're right, there is a lot of action going on out there. In fact, I was just looking at it before the show, and there's a VIX for everything, and there's an emerging markets VIX as well. It trades off of an ETF, and that thing has been just lighting it up lately, up about 40%. I know people get upset when you say percent of a percent because that's what VIX is, but just in layman's terms, it's up 40% to about 28.25. It's even higher now as we're talking. So a lot of action out there in the emerging markets realm as well, off of Argentina and all this other crazy news we've been seeing of late in those areas. But getting back to the volatility products for a second there, Mark Shepard. Too many Marks on the show. When you talk to one of your clients and they call you up and they talk to you about they want hedging, they want that sort of risk management thing that you do, are they even aware of something like a volatility product? Do you even use volatility products for your hedging strategies? Are you more of a direct kind of S&P put spread guy, for example? What's your approach when you're talking vol and with your clients and when you're implementing these hedges for your clients?
Absolutely, that's a great question. I do trade and look at the VIX products. However, a majority of my clients are really into the more equity distribution and more of the S&P 500 index, as well as multi-asset class futures options, just because there's more of a direct correlation to their portfolios. And that's what I try and do, because in order for some of these vol products, as Sebastian already talked about, there needs to be very quick reactive and tactical trading to take advantage of and to harvest the volatility. My clients are more time sensitive and are looking farther out into the distribution of the vol. So specifically, equity options, index options are where my plays are right now.
And as you are holding down the Russell hot seat on the show today, Mark Shepard, we also like to dive into the world of other volatility products, like indeed the Russell. And it's a small cap based product, so it's kind of a little bit more intriguing for a lot of our listeners who are sometimes looking for a product with a little bit more risk premium in it. Of late, there's been some interesting trading out there. We talked recently about what the open interest levels are out there in RVX, and they're doing fairly well. It's about 2,700 as we speak right now, down a little bit, but of course a lot of the open interest was in January, which expired recently, so they're putting on new open interest this week. They're doing some big block trades out there, though, in the size of I saw about a 250 lot go up yesterday, which is about almost 10% of the open interest. So that's it's showing some decent inertia out of the gate here. Mark Shepard, is this something you guys would ever utilize in your practice? Would you guys ever do you watch the small caps at all, or are you pretty much just a big cap guy?
Yeah, absolutely. For asset managers or other ultra high net worth individuals, they may have positions within the Russell 2K, and I would think, especially with hedge funds, possibly they could certainly look at the Russell as a completely different play. You could do all sorts of vol correlation strategies, across the board, certainly.
All right, I think that's going to do it here for the Volatility Review segment, and now we're going to keep on rolling right on into my favorite part of the show, because it's the part of the show that you guys get to join us. It's the Volatility Voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility Voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, and welcome to the Volatility Voicemail segment. This is, of course, a portion of the show where you guys get your chance to join us here on the panel and let your questions and comments be heard for the masses. And both Mark Shepard and Mark Sebastian, I don't know if you guys had a chance to check out the show a couple of weeks ago that I did with Russell Rhodes. It was very interesting, and at the time we had someone write in with an interesting question about the BXM, which is of course the S&P buy right index put out by the SIBO, and their put right index, and both of them are essentially at the money option writing strategies. One writes calls, obviously one writes puts. You'd think they'd be relatively equal from an overall return standpoint, and yet they're not. And the question writer had some interesting questions, and Russell and I kind of went back and forth on that conversation for a while. It was very interesting. And now we have someone writing in based on that conversation with their own take on what they think is actually causing the differential between the BXM and the put right index. This is one of the reasons why I love this show. This audience is great. You guys really get into the weeds with us. You come up with some great ideas and some great answers and some great questions. So both Marks, put on your listening caps, because this is a bit of a long answer, but I think it's kind of interesting. Excuse me, Kyle, cut that. All right, here we go. And this one comes in from Jason Ungar. And I like this so much, Jason's going to be joining us on the program in a week or two to really discuss this in more detail. He is indeed a volatility researcher. But I'll give you guys the Cliff Notes version of what he wrote in right now. He writes, "Hi, Mark. I hope you're well. I just heard your latest, which I think your latest anyway, podcast, which included a question about puts, PUTs, consistent outperformance of the BXM. I know you wanted to look into this, and I think I may be able to help. And it's great that he did, because as usual, I do so many shows here, I didn't have time to get back in and dive into the actual metrics of BXM versus the put index." Jason goes on to write, "While it is tempting to ascribe the differential to the PUT, the puts, it's a little confusing, carrying a higher applied vol than the BXM calls. You may remember, listeners, as that was kind of the first thing we jumped to. And it's kind of your first thought when you think about it. Oh, hey, put wing is going to have a higher implied vol level than the call wing. That's just natural. But of course, when you think about it a little more, these are both at the money options. The differential there really shouldn't be that high." And that's what Jason goes on to say. He says there's almost invariably only a 5-point spread between the two option strikes, and this is too narrow to capture any significant amount of skew. The actual reason for the difference is a bit more complicated and has to do with the index's settlement methodologies. As I'm sure you know, index options settle against a special opening quotation, which was instituted by the CME as a way to price expiring S&P 500 futures. This special opening quotation captures the opening price of all 500 components of the S&P 500, and the anomaly is that on expiration Fridays, the special opening quotation often comes in at a premium to the cash open. The precise reason for this is unknown, but it may have to do with the action of market makers buying back the futures that they use to hedge the short put positions. CME and CBOE, are aware of this. The reason the high special opening quotation is relevant is that it causes the BXM to purchase expiring in the money calls at a premium and the PUT to purchase expiring in the money puts at a discount. This is compounded by the tendency of the market to open strong on expiration and then to tail off. This is good for the put index, which is out of the market for the first 2 hours of trading, and bad for the BXM, which is long the market until new calls are sold at the beginning at 11:30 a.m. Eastern. You can do an easy test to confirm this. Just line up the daily returns for both indexes, which are available for download at cboe.com, and note that the greatest differentials, usually in the PUT's favor, almost always occur on expiration Fridays. I've included a paper I did on this, which I co-authored with Matt Moran, who of course works at the CBOE, as well as a follow-up article. I'd be happy to discuss any of this. All the best, Jason. So both Marks, I hope you guys got a chance to take all that in. It's quite a lengthy answer to the question, but it is a very fascinating thing. And I'm not sure, maybe Mark Shepard, we'll start with you. Have you spent any time, I'd imagine a lot of your clients might be attracted by something like either the put right index or the BXM because they don't want to take the work to actually do it, but they want that kind of level of income, that level of return. So have you looked at these products at all?
I sure have. I was going to ask you to repeat that if you could. No, I'm just kidding.
I don't think we have time in the show to repeat that one.
Russell Rhodes and Jason Unger are both very, very smart individuals and have done some great work in the Vol research departments. Specifically for my clients, I would probably tend to keep them away from one of those products that you were discussing, purely because if there's the possibility that there's not a guaranteed return, that I'm not sure that I could certainly classify that as a good investment vehicle for them. It sounds to me like that might be more of a prop trading or tactical trading product if they're market makers coming in at the end and an expiration and some settlement issues. I would probably look to the liquidity, the amount of money that's already in those products, and see if there is maybe a different product out there that would be a little more clear to understand from a due diligence standpoint.
Yeah, and this kind of hits back, too. I mean, like I said, we discussed this at length on that show we did a couple of weeks ago. Listeners, I encourage you to check that out. Some of the reasons we came up with for why the put right may outperform the call right or vice versa. But it does also get to the things we've hit on this show and many other shows on this network, is that how these products are constructed is very, very important. And when you get into the nuances of settlement and the different ways these hedged products have to be unwound and then put back on, and just simple things like when these products open for trading, they say the devil is in the details, and with these products it truly is. And that seems to be what at least his take is on why we're seeing this return differential in two products that should be otherwise almost identical. Mark, have you really looked at this at all in terms of the BXM and indeed the put right and why one would be favorable to the other? And does this make any sense to you here?
Yeah, I mean they're interesting indexes, but I think one versus the other is is kind of the semantics. I think if you're a firm where you deal with a lot of people who own the actual securities, then benchmarking to something like the buy red index makes a lot more sense. If you're more the RIA type that just puts guys on like the triple income or the wheel trade, then maybe the put right makes a lot more sense. So that's what I'm looking at.
That's a client calling up to be put into the BXM as we speak.
Well, the BBM actually.
Yes. And listeners, if you do want to play the home game and check it out for yourself, of course, BXM, the ticker symbol there is pretty apparent. PUT is the put right index. You can compare the two of them, you get quotes for them, see historical data on the CBOE website, see the products that they're linked to, and trade them. And you can do the research for yourself and see why you think one outperforms the other. And of course, like I mentioned, Jason's going to be on the show, I believe, next week, and we'll dive into that a little bit more detail, some of his research on that space as well. But a very interesting conversation that seems to have lasted. A lot of people are very interested in this topic, so we're going to be diving into it quite a bit more on some future episodes. But for now, we're going to keep on rolling into our next question. I love this guy's handle. This user has the handle Hannibal Smith, so I guess he loves it when a plan comes together, this guy. But he writes, what is the Volatility Views panel's take on the recently announced VolDex product from ISE and Nations Shares? Is it a credible competitor to VIX? This is from our friend Hannibal, and if you listeners haven't had a chance to pay attention to this one, or if either of you Marks missed it, I'm sure you didn't, but this is, of course, something that was announced this week from the International Securities Exchange and the Nation Shares. They make those kind of ETF-enhanced vol products, those option-enhanced ETF products, and they announced what looks like, on the surface at least, to be some sort of direct competitor to VIX. At least from my cursory look at it really quick when I had a chance to look at the release earlier this week, it seemed like the biggest point of differentiation between the two, which seemed a little odd to me actually, was that this new quote-unquote VolDex product is essentially going to be just at the money implied vol, whereas everyone knows the new quote-unquote version of VIX takes into account the skew and all these crazy other options out there on the option chain, whereas this is just looking at the money implied vol. Mark, Sebastian, is that your take on this as well?
Yeah, and which means it's going to be impossible to create a tradable product relative to it, because as soon as you just look at the money vol, watch out for settlement. Will be interesting. So I think it'll be a really interesting index to follow, but I'm not sure if it has some of the same applicability as some of the other ones.
And that's kind of what struck me at first too, is because one of the reasons they revamped VIX is VIX used to be just the at the money vol, and then people said, hey, what about the skew? What about these other options that are also vol intensive, and they should really be taken into account? So they revamped the VIX to take all that stuff into account because people wanted it. And now it's kind of funny to see a new product coming out that essentially says, hey, we're not doing that because people want this. So you're right.
I think the real interesting news of the week is the SIBO announcing the VXST future listing on the 13th.
You're right, and we didn't have a chance to get to that in the vol review, but you're right. They did announce that. Pending regulatory approval, people have been asking a lot, when are these short-term products coming to fruition? It seems like if all holds
the
well,
13th.
yes, if the regulators are on board, then it should be in a couple of weeks here, Thursday the 13th. So we'll stay tuned for that, listeners.
Be all about that. You watch out, guys.
Sell.
Yeah.
I'm gonna be. I'm gonna be the. I'll be the all of the open interest if I can. That's my plan.
So all 8 contracts will be you. No, I think VXXT.
Now, I think this is one that is going to be very, very interesting. People like to call the VIX the fear index, which is kind of stupid and wrong. But this weekly index legitimately represents, am I pushing the panic button or am I not pushing the panic button? And I think it's going to be a much, much better indicator of fear than the VIX itself is.
Yeah, you're exactly right, and that's what all the promotion behind it has been. I mean, look at even the sell-offs we saw recently. The VIX cash popped, obviously, but if you looked at the VXST methodology, it shot up like nearly 40%, I believe. So you're right. You can see played out in that index a lot more what's actually going on in the very, very near-term sentiment. And it also dovetails well with so much interest in the weeklies these days. This is a product that really encapsulates that from a vol perspective, which I think is very interesting. Mark Shepard, what's your take on either of these two products? First off, let's start with what the guy wrote in about, which is the VolDex product. Give us your take on that, what you think is going to be going on with that at the money, essentially implied vol product, and then what you think about the VXST as well.
Sure. I think Mark hit the nail on the head there with the settlement issues. I remember being a market maker on the floor of the SIBO, and anytime the equities would close at the money, you're certainly concerned about pin risk and those sorts of issues. So I could see where that would become a concern for the index in general. For the short-term futures play, I think that could provide some very good hedging opportunities, short-term hedging opportunities for institutional clientele. Though in the weekly settlement, I'll be real interested to see just how that reacts during times of crisis. That'll be a very interesting gauge to watch from the weekly standpoint versus the VIX and some of the other vol products out there. I think there'll definitely be some prop trading and tactical spread trading that could be done, as well as some very positive short-term trading for institutional clients if it's warranted.
Speaking of the clients, obviously the narrative for a lot of people these days is moving into the shorter term, shorter duration type products like the weeklies, which is why there's such a spotlight on the VXST amongst other reasons. Mark Shepard, do you utilize these kind of short-term products at all for your clients, either in the weeklies right now for the equity options, and are you at all perhaps interested in this VXST for your clients, or is it something that's more just theoretically interesting and really for your clients you're going to be more into the a little bit longer-term, longer duration type products?
Sure, it's a great question. I think both, because when I do a due diligence and when I look into their portfolios, of course, I'll do a back test, and I'll look at what would happen if I put on certain products from an option, from a implied standpoint. And I think that certainly both a short-term and longer-term, 3 to 6 month, quote-unquote, option for the client is certainly something that I have to provide for them and want to provide for them, not only from a hedging standpoint, but from, perchance a cost perspective as well. So the more products, the better, as long as it suits the client's interest first.
All right, and we'll certainly keep an eye on both of these, obviously, when they launch, and the VolDex, we'll see what happens with that. We're, of course, interested here in the broad spectrum of volatility and volatility trading. That includes everything that falls under that rubric. Of course, talk a lot about VIX and the options and futures, but of course also the expanding world of ETPs on volatility, and of course this new VolDex product. We're interested in all things volatility here on the show, so we'll keep an eye on these, both of them, and see how they unfold in the marketplace in the coming weeks. And I'm sure you guys will have a lot more questions, a lot more comments on these as we start seeing them unfold in the marketplace. But now we're going to keep on rolling right on into our final segment, the Crystal Ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball segment. If you're new to the show, this is, of course, the portion of the program where we rip out the old crystal ball and see what we think about what's coming down the pike from a volatility perspective. And the last few weeks have indeed thrown a wrench into that prognostication part of the show, because things have been a wee bit crazy, as you might imagine. All the general malaise, the general decline, both from an equity and both from a general vol perspective that everyone had kind of been anticipating, hasn't really come to pass for all the reasons that we hit on at the top of the show. So that makes it interesting here in the old crystal ball segment. Maybe Mr. Sebastian, we'll start with you. Give the other Mark S, some time to collect his thoughts. What's your take here going forward on the week to come from a volatility and a volatility trading perspective?
Well, I think that we're heading for more of the same trouble in vol land, and there's a real good chance that we see. I think within the next week or so, we'll see the VIX of probably 20. And that's something people should be aware of and be prepared for and not be afraid of. I really do think there's a good chance of something like that happening. And realized volatility is going to hang high. We're moving up and down 1%. If you look at from stock open to close, right now, S&Ps are unchanged as I look at it. So that means we made a full 1.5% round turn. That's volatility. And, some of the other measures of vol, maybe not GARCH, but, different VWAPs and all the different ways of measuring day-to-day volatility are going to be continuing to rally here. So that's where I think there's people need to be paying attention and watching and learning.
And it will be interesting when we have something like a VXST actually out there trading in the marketplace to see how that reacts to stuff like today. Because you're right, we had literal volatility on display today and what we're seeing in the indexes, and that will be something that a VXST would capture in even greater detail than what we have now in the VIX cash and the VIX futures and all that other fun stuff. So I'm looking forward to when that launches in a couple of weeks and we have even more metrics and products here to discuss on the old program. Mr. Shepard, what is your take there from the consulting side of the fence? What are you watching? What are you anticipating for the week to come from a volatility perspective?
Absolutely. I think that we'll continue to see, as Mark says, some realized volatility let me throw some politics into the fray here, because clients come to DSC for political analysis as well. You're going to have the debt ceiling debate coming up. And from my point of view, from what I see, I think it would be unwise for the Republicans not to extend the debt ceiling. And because of many issues going forward with, I believe, 12 senior Democrats now either leaving the Senate or the House, as well as, some very serious concerns about the Affordable Care Act. You're now looking into election season 2014. So I think this all becomes a part of what's going on in our world, in our markets. People will continue to hold those calls, as we've seen, those calls on VIX until the debate, and then probably sell out a little later, or just keep them on and let them, go to zero, whatever. But I think after another month or so of volatility, we could see a very significant rally in the markets if there is consensus around the debt ceiling, as well as potentially with the Keystone pipeline. And that's another area that clients have been asking questions about, because oil and our energy policy, oil WTI has been staying between 93 and I believe about 105 for quite a while, and there has not been a significant drop due to supply concerns. So the fact that there's a possibility that the Keystone X could come online very soon, would portend well for a lower oil price from DSC's point of view.
So you make a good point there. We don't really hit on the commodity vol, but there's been a lot of vol in that neck of the woods of late. Of course, nat gas has been moving quite a bit, and you mentioned WTI as well. So do you spend a lot of your time over there doing analysis and risk management from a commodity and commodity vol perspective, as well as in addition to just the general plain old vanilla S&P 500 vol?
Yeah, so a good deal of commodity hedging, and have the ability and conception to practice that for and deliver those capabilities to individuals, not necessarily in nat gas, but that's part of the overall energy portfolio that can be constructed. Most recently focus on WTI and Brent, and the politics around that as well.
And you mentioned politics, of course. For better or for worse, politics was a big driver of market vol towards the end of 2013. It sounds like from what you just said, you don't think it's going to be as big of a driver here coming up in the end of Q1 as we get back into these debt ceiling debates. You don't think we're going to see another government shutdown-esque type of vol where we're seeing the government really just injecting orders of magnitude new vol into the marketplace in the coming months?
I think, as I mentioned, I think that would be very silly for all politicians not to come together again and deliver for the American people. I think politically it would be disastrous for the Republicans, and probably for a few Democrats. Everyone's looking for November 2014 right now. So I would be very as a citizen, I would be disturbed if something like that happened. But I think portfolio managers and risk managers, from a client standpoint, have to keep the risk mitigation on, whether it's a tail risk or whether getting into some short-term trading with the new products that we've talked about. They have to be in those just in case something happens.
All right, well, that is going to do it for the crystal ball portion of the show. But before we go, as always, I'd like to check in with each of my cohorts, my partners in crime here, to see what they have cooking in their respective necks of the woods that may interest you, the listener. Mark, I know you're busy with a bunch of different stuff over there. Mark Sebastian. Too many Marks. Mark Sebastian, I know you're busy with all the different things you have going on over there at Swan, in addition to what's going on over there at Option Pit. Why don't you give our listeners a quick overview of what you guys have coming up?
At Swan, we're doing all kinds of cool stuff, but, we just continue to go out and try and do what we do and to try and help people. And, one little project that Randy is working on was Swan Re, which is Swan, our new reinsurance corp. And I think it's a really interesting trade and a really interesting product that we think is going to be the new way to get into for money managers to work with investors and potentially overtake the traditional hedge fund model long term.
Yes, I know, talking to Randy, and listeners, if you haven't heard that, check out our Advisors Option Program, where Mark's cohort there, Randy Swan from Swan Wealth Advisors, is on that program. He spent a lot of time. He's very giddy. He's very excited about the reinsurance prospects and what that potential may hold. And that makes sense coming from his, actuarial insurance background. That type of product really dovetails with his background. So it'll be exciting to see what that actually can do in the coming months and years. All right, and Mr. Shepard, tell our listeners, what you're working on over there at Derivative Strategy Consultants, what they can look forward to coming from you guys in the coming weeks and months, and indeed, if they want to learn more about what you guys have going on, where they can go to do that.
Yeah, absolutely. www.derivativestrategyconsultants.com is the website. We're also on LinkedIn and at ShepDSC on Twitter. One additional item that DSC is actively engaging in is called experiential consulting. And what that is, it's big data analytics with a handshake. And what DSC does is provides consultative services for financial institutions to go and talk with clients. And we believe that because of our background, we're able to assess and determine really what the end user wants from the firm. So instead of these clients really not willing and able to talk with their clients, DSC comes in as a consultant and talks with the client about their user experience. So that's a very exciting aspect of what we're doing. And secondly, DSC will be at the Institutional Investor Conference in Washington, D.C., March 13th and 14th at the Ritz-Carlton. And we'll be talking with endowments, foundations, and pensions about mitigating risk in their portfolios.
Well, there certainly is a need for someone to come and do that and be that intermediary, if you will, particularly from a derivatives perspective. And I like that you take the D word and you just embrace it. So many people in this business, us included here on the network, we run away from that word whenever possible because it is so loaded. So many people see it as pejorative, particularly in the realms you're working in the asset and money management side, where so many people just see derivatives as being this incredibly risk additive type tool as opposed to risk mitigating. So I like the fact that you've just embraced the D word in all of its glory and you've named your firm around it and you put it front and center on your website. So you're taking the opposite approach, and I'm glad to see that it's working for you more.
Thank you. Yes, I embrace it. And as with anything we all do in the business, I'm sure with Mr. Sebastian as well and the guys at Swan, it's all education, it's communication, and it's marketing. And with our background and our respective practices, we have to talk about it every day, and that's what we live for, and that's how we deliver client best services.
All right, again, if you want to learn more about what Mark S., the other Mark S., has cooking, then surf on over to Derivative Strategy Consultants. You're bucking the other trend, too, Mark. In the Web 2.0 world, everyone's going shorter URLs with, no vowels, and you've gone You've gone completely the other way and just fill out the whole address bar. I like it. Bucking
Longest
all the
ever.
trends.
Yes.
All right. And of course, if you'd like to join us here on the old program for the volatility voicemail segment, a lot of great ways for you to do that. You can, of course, surf on over to theoptionsinsider.com and leave a comment on the show notes of this program. And we'll, of course, route it to the appropriate show, which would be this one in this case. So that works out pretty well. But you can leave a comment on pretty much anything on the site and we'll route it to the appropriate show. Of course, you can find us on email. A lot of you still like to do that the old-fashioned way. Questions@theoptionsinsider.com. Just be sure to put question for Vol Views in the subject line so we know exactly which show you're referring to. Or you can find us on social media, Twitter and Facebook. Twitter.com/options, Facebook.com/theoptionsinsider. Leave us your comments, your questions there. A lot of you guys love to use Twitter. I think that 140-character thing really boils down your comments and questions to their essence, to their pithiest heart. And, of course, for the Volatility Voicemail segment, we also have the Volatility Voicemail number. You can leave us an actual Vol voicemail at 773-669-4VOL. That is 4865. Leave us a voicemail. We want to hear your actual voices reading the questions. Leave it to 30 seconds to a minute. And if it's interesting, if it's fun, we'll be sure to play it on the show. And on behalf of Mark S. and the other Mark S. and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success, and for re-embracing and welcoming Vol Views back with such open arms. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.